is the ECL model, and this is what is the main focus of our workshop, which is basically looking at how to model the expected credit loss. When do we use a 12-month credit loss? When do we use a lifetime credit loss? When do we calculate interest on which amounts? I will be sharing a copy of these notes for your perusal also. So don't worry about that. So now the accounting standard has made a clear distinction in terms of the financial assets and how the ECL modeling is done. They have basically separated the investment type assets from the receivable type assets. So if I'm talking about trade receivables or if I'm talking about lease receivables, then they have separated those out. So if you see, these are receivables which arise in the regular course of business, and these are acquired receivables. What does that mean? These are loans that you have given to others, or these are investments that you have made in the uh, debt instruments or bonds of other entities. So for that, the rule for this is a simplified approach to ECL modeling. This is the long form approach. Okay. Now let's dig deeper into each of these aspects. What the accounting standard has done is that for trade receivables and for lease receivables, it has made certain simplifications to the ECL model. And why was that decision made? Now, these are operational simplifications, and these are basically introduced for those entities that do not have a sophisticated credit risk management system. These simplifications eliminate the need to calculate 12-month ECL and to assess when a significant increase in credit risk has occurred. Basically, what they are saying is that if you're talking about a manufacturing company, or if you're talking about me, I am in the service industry. My job is to train participants and collect money from them. Now, for example, there is a participant or there is an entity to whom I have rendered a service, but that entity has not yet paid me. So I stand to face a risk of default. But the question that I have for that is it possible for is it fair for IFRS 9 to impose a model which expects me to calculate 12-month expected credit loss and do a lot of complex calculations? Or is it better from a perspective where they simplify the entire approach? Because I do not have a sophisticated model which will basically help me to estimate the credit losses for the next 12 months, credit losses for a longer duration. And let's face it, for the kind of receivables that somebody like me would have, such complex calculations are not even required. If a student or if a participant has not paid me, it's a very simple calculation where I will have to calculate the loss allowance by estimating the probability of default, and that would be my loss allowance. And I will not have to pass it through a complex mathematical model or even create a provision matrix in that case. So let's understand, what does IFRS 9 say for trade receivables and lease receivables? Trade receivables. Trade receivables and lease receivables. So there is an operational simplification for trade receivables, contract assets, and lease receivables because they are held by entities that do not have sophisticated credit risk management systems. For trade receivables, contract assets, and lease receivables, IFRS 9 has prescribed a simplified approach to calculation of expected credit losses. The reason is they are held by entities that do not have sophisticated credit management systems. These assets are often held by entities that do not have a sophisticated, refined credit management system. So, and what does the simplification entail? The simplification eliminates the need to calculate 12-month ECL. The simplifications in IFRS 9 involve the following. What do these involve? One, eliminates the need to calculate 12-month ECL. Eliminates the need to calculate 12-month ECL and eliminates the need to assess when a significant increase in credit risk has occurred. Eliminates the need to assess when a significant increase in credit risk has occurred. So, see, to decide whether a significant increase in credit risk has occurred, you will have to evaluate the specific conditions of the other entity. You will have to evaluate the market conditions. You will have to evaluate the overall state of the economy. You will have to keep a tab on, the news items that are appearing in the market. So multiple situations are possible, and a smaller entity or an entity whose see, for me, the main focus is conducting as many trainings and collecting cash from students. I cannot waste my time in calculating, oh, whether this candidate is going to pay me on time and whether a significant change in credit risk has taken place for him because the conditions in his or her country have worsened or whatever. Like yesterday, we took the example of Bangladesh. I don't have the time to assess that, and neither do I have the expertise and the resources to assess that. So for people like me, IFRS 9 comes to my rescue through these two simplifications. So, for trade receivables or contract assets that do not contain a significant financing component, loss allowance should be measured at initial recognition and throughout the life of the receivable at an amount equal to lifetime expected credit losses. So, for trade receivables or contract assets that do not contain a significant financing component. We saw what the significant financing component is. The loss allowance should be measured at initial recognition and throughout the life of the receivable at an amount which is equal to lifetime expected credit losses. Now, like say for example, I have a total debtors of 1 million, and I know that every year around 0.5% of my debtors do not pay me. So this is my expected lifetime loss. So over the lifetime of this set of receivables, I expect that around 0.5% of my receivables will not pay me. So the loss allowance at initial recognition and throughout the life of the receivable should be measured at this number only. What is this number? The lifetime expected credit losses. On the other hand, in case of other financial instruments, you would have to do the 12-month calculation. You would have to assess, whether there has been a significant increase in the credit risk here. They have eliminated that. All they are saying is very simple. They are saying if it is a trade receivable or a contract asset which does not have a significant financing component, then at the initial recognition, you estimate what is going to be the lifetime credit losses. And whatever is the amount of lifetime credit losses, that should be your loss allowance. No need to complicate it further. Now, to make our lives easier, the provision matrix is basically used for these financial instruments. A provision matrix is employed for these financial instruments. And let's go here. This is allowed if the reporting entity bases the matrix on historical default rates as well as observable data about current market conditions and forecast of future conditions. What we can do here uh, as an example is we can do this. We can just put a picture of this flow chart. So these could be the gross carrying amounts. Okay. These could be the default rates could be Y%, Z%, A%, and B%. I mean, just any number that, is, and then you will get the expected credit loss. That should be the calculation specifically for trade receivables and lease receivables. Trade receivables and lease receivables that do not have a significant financing component. Okay. So there, the simplified approach in ECL is allowed.
Okay, in this case, if, for example, if one of we are having only one or two lease receivables, and they have been very prompt in making the payment, and we are not expecting any default from them at all.
Hmm.
Okay, in that case, can the expected credit loss be zero?
Yeah, yeah.
Okay, fine.
100%, no problem there. So,
Yeah.
I mean, when we are transacting with new customers, I'm sure you are aware of the policy of customer due diligence that happens, right? A KYC,
Yes.
know your customer that happens. No business entity out of its own volition would want to work with a person who is basically a credit risk at the time of origin itself, or who has had a past track record of delaying the payments or not making the payment. You would want to avoid working with such a business entity, right? So ideally at the time of making a sale to a new customer and recording a trade receivable, there is a very high probability that the lifetime expected credit losses could be zero.
Yes.
Okay.
Okay, fine. So the same thing applies to trade receivables as well.
Yes, yes, yes. 100%.
Okay, fine. Thank you.
Most welcome. And for trade receivables or contract assets which contain a significant financing component in accordance with IFRS 15 and lease receivables, an entity has an accounting policy choice. Either it may apply the simplified approach, that is, to measure the loss allowance at an amount equal to lifetime ECL, or it can apply the general model. What is the general model? Monitor significant increases in credit risk. If there is a significant increase in credit risk, then you will have to use the lifetime expected credit losses. If there is no significant increase in credit risk, then you will have to calculate the 12-month expected credit losses. Now, just to, reiterate, let's go back here. Let's go back to, the basics that we covered yesterday. A 12-month expected credit loss is the portion of lifetime expected credit losses that result from default events that might occur 12 months after the reporting date. So if you are calculating 12-month expected credit losses, your calculations should focus only on a limited number of months, and that is 12 months from the reporting date. What defaults do you expect in the 12 months after the reporting date? You have to calculate those, and that will become your 12-month expected credit losses. Like we saw in this, we did one question on this, right? Yeah, this one. What did we see in this question yesterday in this calculation? We considered that if a default occurs, what is the default that is expected to occur in the next 12 months? The amount of default in the next 12 months, that is your 12-month expected credit loss. Lifetime defaults are basically if a default takes place, what amounts would you end up not receiving over the entire life of the financial asset? So we'll modify this a little. Trade receivables to. So this is not trade receivables and lease receivables. This is trade receivables and contract assets without a significant financing component. And this is trade receivables and contract assets with a significant financing component plus lease receivables. Now, in these cases, you have an option. The accounting standard here gives you an option. What option does it give you? It says either use the simplified approach, calculate the lifetime expected credit losses, and show the ECL at that amount. The other option is monitor the significant increases in credit risk. So let's again try to map this in the form of a simple flowchart. So policy choice, or rather for trade receivables, contract assets with a significant financing component, and lease receivables. Now, see this, it's not for nothing that they have clubbed these assets together. Actually, think about it. If you think about it, all lease receivables are what? All lease receivables are basically a leasing arrangement is a financing arrangement. I'm sure you would agree with me when I say that a leasing arrangement is a financing arrangement. So here, what assets are we talking about? We are talking about those financial assets which basically have a financing component. Trade receivables with a significant financing component, there is a financing element present. And a lease arrangement is basically a financing arrangement, because what you cannot purchase outright, you take it on lease and you pay the amount due in installments. The asset might become yours or might not become yours at the end of the lease term, but a leasing arrangement is basically an alternative to an outright purchase. I'm sure in your graduation studies, in your other studies, you must have done these questions, which basically ask you to evaluate between what is better, a leasing option or an outright buying option. I think that is one of the favorite questions that they have when they are testing you on different financing alternatives. So the second leg, see here, the second leg, does the trade receivable or contract asset contain a significant financing component? Answer is yes. Or we are talking about a lease receivable. We are basically talking about those assets which involve extending financing facilities to others. Extending financing facilities beyond the normal. If I am selling goods to you on credit, I am allowing you to pay me, say, 30 days after the date of sale. But here, if there is a significant financing component, that means there is a significant difference between date of sale and the date of collection. And the amount that you collect on date of collection is more than the consideration you would have collected if the customer would have paid on the date of sale. So when I'm talking about this situation is that case where you are not only selling goods to a customer, you are also providing him with a financing facility. And lease arrangement is a financing facility. So here, there is a policy choice. Policy choice. When I say policy choice, it automatically gives me two alternatives. Use simplified approach. Calculate lifetime expected credit losses. Calculate lifetime expected credit losses, and you are done. The second option is different. Second option is, don't use the simplified approach, use the full ECL approach. And what does that involve? That involves check, or rather ask the question, has there been a significant increase in credit risk from the date of initial recognition. Has there been a significant increase in credit risk from the date of initial recognition? If the answer is no, then loss allowance should be equal to 12-month expected credit losses. And here, loss allowance will be equal to lifetime expected credit losses. So, when does IFRS 9 give you a policy choice? The IFRS 9, the accounting standard gives you a policy choice when when you are talking about financed assets or assets that have a financing component present. In that case, you do get a policy choice. Now imagine if you want to change the accounting policy, it will have to be done as per IAS 8. IAS 8 is accounting policies, changes in accounting estimates and prior period errors. So if you want to move from a simplified approach to a full ECL approach, then naturally you will have to make changes to the financial statements. There will have to be a retrospective implication as well. So this is what you do in case of those trade receivables and contract assets which have a significant financing component and lease receivables. Ask yourself the question, has there been a significant increase in credit risk from the date of initial recognition? Answer is no. Loss allowance is 12-month expected credit loss. If the answer is yes, the loss allowance is lifetime expected credit losses.